Welcome to JM Financial Mutual Fund's Fixed Income Outlook. In this short video, we would take a look at how different global and domestic factors behaved during the month gone by. We will also share our views on the domestic fixed income markets, which could in turn impact the positioning of our schemes. Global yields remained relatively volatile in the month of July 2025. 10-year U.S. Treasury bonds traded in the range of 4.24% to 4.35%, intermittently touching a high of 4.50%. During the month of July 2025, 10-year U.S. Treasury bonds, 10-year Japan government bonds, and 10-year German Bund hardened by 11 basis points, 12 BPs and 10 BPs respectively, in response to the respective countries' domestic macroeconomic data releases, as well as tariff-related trade negotiations weighing heavily globally. U.S. Treasury yield remained volatile during the month of July 2025. The month started with U.S. House of Representatives passing the Big Beautiful Bill, estimated to add approximately $3.3 trillion to U.S. already high debt in next 10 years. Also, better than expected non-farm payroll data for June 2025 at 147,000, expectations of 111,000. Unemployment rate moderated to 4.1% versus 4.2% in May 2025, while average hourly earnings showed growth of 0.2% MOM. These factors lead to a sharp increase of 6 basis points in UST 10-year, leading it to reach 4.35%. Federal Open Market Committee meeting minutes revealed that most members had persistent tariff concerns. U.S. President Trump announced a 15 to 20% baseline tariff from 10% earlier announced. Consumer Price Index year-on-year increased to 2.70%. Expectations of 2.60%, causing the U.S. Treasury yield 10-year to inch up to 4.49%, as unclear tariff negotiations weighing on inflation increased the expectations of a pause in July 2025 policy, and also a decreasing probability of a September 2025 cut. Federal Open Market Committee policy meeting held rates at 4.25% to 4.50%, though with double dissent, stating moderately restrictive policy seems appropriate. Eurozone. European Central Bank maintained its policy rate at 2.15% after 8 cuts in a year, which is nearly half from its high of 4.00% reached during COVID-19 pandemic phase. As Q1 calendar year 2025 reflected strong growth, while inflation reaching European Central Bank target of 2.00% with expectations to stay there, policymakers highlighted that they are cautious about tariff-related trade negotiations with U.S. being in their final stages and would take further policy actions depending on incoming economic data. China Q2 calendar year 2025 printed 1.1% versus expectations of 0.9%, and Q1 calendar year 2025 reading of 1.20%, and retail sales for the month of June 2025 printed weaker at 4.80% versus 6.40% for the previous month of May 2025, indicating resilience to U.S. tariffs. Bank of Japan kept its interest rate unchanged at 0.50%, with a caution to increase rates in future. Japan 30-year bond remained averagely above 3.00% for the month of July 2025, with 10-year 30-year bond spread widening to an average of 1.52% versus 1.47% for the previous month. Japanese yen showed a sharp depreciation to close at 151 from 144 in June 2025, vs US dollar. Japan 2-year bond auction resulted in hardening by 11 basis points, showing lackluster demand. Globally, long bonds remain under pressure due to fiscal worries. The 10-year G-Sec traded in a band of 6.28% to 6.37% and closed at 6.37% in July 2025, vis-à-vis 6.32% in June 2025. India benchmark yield largely remained range-bound with no major triggers for the month of July 2025. Market took cues mainly from volatile US dollar per Indian rupee, which moved from closing of 85.52 of June 2025 to 87.60 in July 2025. Crude oil prices also weighed with it, moving approximately $5 per barrel during the month. Lower end of the yield curve was mainly driven by average surplus liquidity of Indian rupee 3 trillion, with regular RBI variable rate reverse repo and voluntary retention route operations. At the start of the month, the longer end of the curve saw some buying by insurances and pension funds at attractive spreads. At primary auctions, yields of 91-day T-bill and 182-day T-bill softened by approximately 1 basis point and approximately 2 basis points respectively, while 364-day T-bill remained flat in July 2025 due to the reasons mentioned above. Consumer Price Index (CPI) inflation stood at 2.1% in June 2025, the lowest reading in over 6 years. The reading also came in lower than the Bloomberg's median poll of 3.00%. Quarterly Consumer Price Index for Quarter 1, fiscal year 2026 stood at 2.7%, lower than the RBI's estimate of 2.9%. Food and beverages noted a deflation of 0.20% in June 2025, which is the lowest reading since January 2019. Deflation in this segment was led by vegetables, which noted a deflation of 19% in June 2025 on a year-on-year basis, led by a sharp decline in prices of potato, onions, tomato, etc. Along with vegetables, pulses also noted a deflation of 11.76% in June 2025. Cereals noted continued disinflation, further supporting the decline in food prices. Inflationary pressures remain from oils and fats, which have shown a double-digit inflation in the 8th consecutive month. Core inflation witnessed an uptick of 4.43% in June 2025 as compared to 4.17% in May 2025 due to the rise in prices of miscellaneous items, especially gold and silver. The inflation has cooled off in the past few months, aided by a sharp decline in food prices. The Monetary Policy Committee, MPC, has shown confidence in the disinflation process and has thus revised the FY26 inflation projection lower from 4.0% to 3.7%. The RBI expects inflation to remain below the target of 4.0% in Quarter 2 fiscal year 2026 and Quarter 3 fiscal year 2026, before rising to 4.4% in Quarter 4 fiscal year 2026. During the month, dollar index appreciated by 3.19% as compared to a depreciation of 2.47% in the previous month, as clarity emerges on the tariff front. The evolving trade dynamics and a potential trade war can impact U.S. growth adversely. Though the dollar index has appreciated for now, increase in fiscal deficit on account of the recent tax cuts, and a slowdown in economic growth can exert pressure on the dollar index. The Indian rupee witnessed a depreciation of 2.15% in July 2025. The currency traded in the range of rupees 85.32 to 87.60 per US dollar during the month, and ended the month at rupees 85.60 per US dollar. In terms of the 40 currency real effective exchange rate, REER, Indian rupee continues to be overvalued, above 100. However, it has come down significantly from the recent high. Also, in May 2025, Indian rupee on a REER basis dropped to 101.08, lower than the 10-year average of 103.5. In June 2025, FPIs were net buyers in equity with net inflow of US $1.7 billion, while debt markets observed a net outflow of $2.6 billion during the month. Forex reserves, after making a low in January 2025, have continued to remain elevated, partially owing to RBI's US dollar per Indian rupee buy-sell swap. After crossing the $700 billion mark towards the end of June 2025, Forex reserves fell by US $7.3 billion and stood at US $695.5 billion as on the 18th of July 2025. Liquidity conditions during July 2025 continued to remain favorable. The banking system noted a daily average surplus of rupees 3.04 trillion in July 2025, compared to a daily average surplus of rupees 2.73 trillion in June 2025. RBI has taken active steps, including open market operations, OMOs, purchases, and US dollar per Indian rupee buy-sell swaps, to infuse about rupees 7.4 trillion worth of liquidity into the system since January 2025. With an expected liquidity boost of rupees 2.5 trillion from the recent cash reserve ratio (CRR) cut, a total liquidity of around rupees 10 trillion shall be infused in the economy by December 2025. In the fortnight ending July 11, 2025, bank credit grew by 9.8% on a year-on-year basis, while bank deposits grew by 10.2%. On an fiscal year-to-date basis, bank credit grew by 1.2% as compared to bank deposits, which grew by 3.3% in the same period. Credit deposit ratio stood at 79.2% in the fortnight ending July 11, 2025, as compared to 78.9% in the previous fortnight ending June 27, 2025. U.S. gross domestic product for Q1 calendar year 2025 has been revised downward to -0.5%. Preliminary reading was -0.2%. However, business sentiment and consumer confidence in the U.S. still seem to be giving mixed signals. The U.S. tax bill is expected to add to the fiscal pressure that the U.S. is currently facing. As mentioned earlier, growing concerns over elevated debt levels in major developed economies, particularly Japan and U.S., is keeping yields elevated. On the inflation front, though inflation is receding, it remains above the Fed target and tariff concerns pose further risks. While the labor market remains strong and there are upside risks of inflation, we expect Fed's actions to be data-driven and expect the Federal Reserve to deliver rate cuts unless growth significantly weakens. While Bank of Japan has kept rates unchanged in its previous policy, it is likely to continue its rate hike trajectory. The continuing unwinding of yen carry trades may affect U.S. yields adversely. The impact of tariffs on growth may be seen with a lag of a few quarters. We may note that further rate cuts, post-September 2025 policy, by Federal Open Market Committee may take place in case of a sustained deterioration in growth or if labor markets materially weaken. China's continuing sluggish economy has support from both monetary and fiscal side to get its economy back on track. The resultant impact on commodity cycle upturn may be a development to be watchful of, especially for import-dependent nations like India. Furthermore, the global geopolitical escalations have put pressure on crude oil during the month, causing oil prices to range between US $63.90 to US $78.85 per barrel. RBI continued to show consistent support to the economy through ample liquidity measures resulting in systemic liquidity surplus in the month of July 2025. Such support from RBI is expected to continue to increase monetary transmission of rate cuts. With most of the domestic positive factors priced in, the coming months may see bond markets react to prospective credit reserve ratio cut-linked inflows, foreign portfolio investment flows into bond markets, and global cues such as U.S. Treasury yield rates, Federal Open Market Committee rate actions, crude oil prices, and other geopolitical factors. Given the ample liquidity conditions, expected credit reserve ratio cut-linked inflows, and a benign inflation projection, we may see bond participants continue to robustly participate at the shorter end of the curve. We may see a relative underperformance at the longer end of the curve, leading to a continuation in the steepness of term spreads.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.